We're back.
We're back. So is football.
Yes.
Who's your team?
Great question. I don't have a team, actually. So I grew up in LA. I rooted for the Rams, and then they left when I was like 12, which is not a fun thing. Your team leaves. And not only did they leave, but they went off and won a bunch of Super Bowls and became the greatest show on turf. And I got to watch that from LA and watch them win Super Bowls on TV. And I don't know, they moved back, and I thought I'd be able to be fans of theirs, but I'm still apparently burned. I got these seated feelings of abandonment, and I don't feel like becoming a fan of theirs again, even though they came back to town and won a Super Bowl, and you'd think like, oh, you could get on board, but I just can't do it. Like I was at I went to the Rams-Niners game on Sunday. That was awesome. Like couldn't bring myself to root for the Rams. Could bring myself to root against San Francisco. Okay. So I was cheering for the Rams, but only because it was more of an anti-San Francisco stance than a pro-Rams stance. I'd love to get there. I just can't. So I impartially watch football, which is kind of boring.
Yeah, I mean, you strike me more as just like you're just Mike the baseball guy. I mean, it's just the Dodgers thing, and that's your identity.
It's also by far my favorite sport. I like football. I just don't have that emotional connection to anyone. Unlike you, but the Saints here apparently playing great defense.
Yeah, I adopted the Saints when I moved down to New Orleans. I got the house there, and because I was previously a split Bills-Jets household where I fell under the Jets category.
Oh, my gosh.
And so it was just a struggling franchise. And as soon as I moved to New Orleans, I was like, I have a reason to get behind this. Also, just economically speaking, to kind of like bring it together. It's impossible. It's impossible. Not impossible, but it's a pain to get to the stadium in Rutherford, New Jersey, especially coming from Long Island. Whereas the Saints, I mean, like you could just walk down the block and you're in the center of New Orleans.
Oh, that's
go right
cool.
into the game.
That's a cool setup. Yeah, it's so odd that the Jets play in Jersey. Yeah, that's a really weird. And the good thing to get away from that franchise is just like heartbreak after heartbreak. Sure. And you watch Aaron Rodgers. What a bummer. So it's, the fan base was so excited, and I was like feeling happy for him.
Yeah. But when it comes to business, it's just location.
Yeah.
And the other thing too about that is just make it as easy as possible for your customers to appreciate and enjoy your business or to utilize your business. If it's annoying, this is the thing I have even about like pricing. If there's no prices clearly available for me to see like how much does this cost, it deters me from even wanting to shop at that place. Oh, and it also, I'm just like, oh, well, if you have to ask, you can't afford it. But
I think it's fair. If they don't have prices, you can assume it's expensive.
Yeah. But the accounting industry seems to be turning into a bit of the Wild West. I'm excited for this segment. There's a lot of stuff going on all over the place.
Interesting stuff. Good changes, potential looming future fraudulent cases. I'm excited to chat through here. But yeah.
My mantra for this episode is you could take the boy out of audit, but you can't take auditing out of the boy.
It's very true.
And I've been living by that. So this is episode 15 of the FinTech Flo. All right, what's going on, everybody? Welcome back to the FinTech Flo. We came back from summer break here. Finally good to be back in the office. Football season's back. Excited about that. I'm your co-host, Drew Carrick.
I'm Mike Whitmire, co-founder, CEO of FloQast.
Yep. And we're starting off with some really exciting news. I know, Mike, before the podcast, you were talking about how you were pumped to hear about this. It's from Accounting Today. Accountants on the new FASB crypto standard. It's about time. Yeah.
And perfect timing. I found myself listening to the first bit of an interesting podcast last night where they're talking about the change here. And really helpful. So maybe I can I'm sure it's in here, but maybe we can set a little context before we hop into it. So before this ruling, crypto was accounted for as an intangible asset, and you could only reduce the value of any crypto investment. Mm-hmm. You could never mark it up at any point. So by definition, if you purchased any crypto asset, you were only going to lose money from there on your balance sheet and your income statement. There was nowhere else to go but down.
Right.
So how do you account for, let's say I bought Bitcoin at $20,000, it drops down to $5,000. We get to the end of a quarter, I have to mark it down to $5,000. I have to take an operating loss from that, even if I'm a restaurant. I have to take an operating loss from this. And then the next quarter comes around, let's say Bitcoin goes back up to 15. You don't get to mark that anywhere on your balance sheet or your P&L. It does, it doesn't go back up. It sits at 5 and you don't make any changes. And that to me is just really a poor way to think about a very liquid asset. I could take it tomorrow and sell it. That's a much more accurate reflection of my balance sheet is what is the true value of this when it's something that is quantified by the second. You have a fair value by the second for this thing. And so this is changing it to now be accounted for as a security where you can mark to market securities on a regular basis, and the fact that it's like a hard and set price, it makes a ton more sense. Yeah. More accurate financial accounting.
Well, and you have like, I remember the level 1, level 2, level 3 investments, and there's different testing methods when you're auditing each of these different things. This is a very straightforward thing. There are markets that...
I don't know that world really well. Can you tell me more about like what that means?
So you had like level 1 investments that are easily identifiable. Level 2, which gives you kind of alternative methods of figuring out what the value of something.
So one is like a share of stock. Yeah. Would be a really easy one.
Very
is what's like a good example of maybe an office building? Or...
You could give, again, it's more investment based. Okay. So not necessarily, I mean, it falls under the assets, of course, but more so like a business that has an identifiable value. And then 3 could be, I mean, that's like Enron stuff where it's some future project, project in some foreign country that you're not sure how much. Oh, we've invested in the Boswali government. I don't know.
Okay,
so something that's difficult.
And then your audit standards are tighter when you get to a level 3. Like you're way more forgiving on level 1 because you can just tie it to a brokerage statement, and then
it's so easy to audit. It's so easy to audit a level 1 because you just pull the how much was it worth as of December 31st. It's everybody knows it's the open market that you can publicly see. And so it was shocking to me that they would categorize crypto in this intangible. And again, this new legislation only applies to those security type ones. They have to be, it excludes NFTs, wrapped tokens, which derive their value from other assets, and or governance tokens, which value through a right to an action. So by having this token, I have a right to do something.
Yeah, you have to clearly have a liquid security. And I don't even know, would that extend to like the Doge coins of the world, or do they kind of...
Doge is tough. That's borderline level 2 in my opinion. But I don't know. As far as I'm concerned, it's just, I mean, Bitcoin, Ethereum, these are just things that like you see how much they're trading at any given day. It should just be viewed as like the stock market. Yeah. It's just viewing it as a stock.
I agree. Like if you take a huge step back, and the idea of a balance sheet is to reflect the financial health of a business. If you know the fair market value of a liquid asset is a certain dollar amount, that should be reflected on your balance sheet. And so it's nice to see a shift where it's just like, take a big step back, macro-wise, you understand accounting, all the principles and everything. This is clearly a step in the right direction. And so that's good to see.
And the thing about, I mean, the fact that you'd even consider that it would be an operating loss, because it's not in your operations. Like you said, if you're a restaurant, investments are not is not the business that you're in. Yeah. So why are you categorizing things on your income statement as part of your operating loss? I mean, even as an operating gain, it's not part of it. I consider it extraordinary. It's not normal.
Yeah, or an investment, like if you want to go, if you want to head in that direction. So here's an interesting thought. There are public companies that have been holding crypto for a while. Mm-hmm. Like Tesla has some Bitcoin on their balance sheet. I don't know how much, and you can't tell how much because it's not accounted for in a really intelligent way. So all these rules get changed. What if Tesla bought Bitcoin at a pretty cheap price? They got a good amount of it. It goes up, and then they have to enact this new accounting guidance. How does that flow through the P&L and everything? Do we all of a sudden have a 10Q where Elon's like, and we profited $2 billion from Bitcoin last quarter simply because of a one-time mark? Because the price of Bitcoin's back up again. It is. You know, it's at a decent level to where I think a lot of people who purchase are at least even, if not up. And they're certainly up from when they would have had to mark it down to. You know, if you think about where Bitcoin went, at some point over the last 12 months, you would have had to mark it down to something like $5 to $8 grand. I think it went pretty low. And so now if it's sitting at 20 or 25, it could be sitting on a really big.
That's actually mind blowing. I had
not financial advice. Not financial advice.
But that's a mind blowing concept because are they having one giant catch up to be like, well, now I don't even like the idea. The other thing too is it's so volatile that I don't even like the idea of it going up and down and losses, gains. I mean, that's got to be just like an extraordinary item disclaimed somewhere else.
Yeah, but the point I made, this is going to be the most acute gain booked because by doing intangible, it is marked at the lowest price that ever existed in the history of this asset. And now we're going to mark it up, and it's going to give, I think we have 18 months to enact this. It's like December of, maybe it's 2025, I think is the enactment period. And so you're going to have some time frame where all these companies who have marked it at the lowest price that's ever existed are going to mark it up to whatever the price is at that point. And if it's much higher, it's going to be like a material 1 quarter gain. Do you take it all in that existing period? Do you go back in time and retroactively restate financial statements? I really doubt you're going to do that. So you're going to catch it all up through retained earnings, right? And but like it's going to, I don't know. That's the actual implementation of it's really interesting because it can really muck up financial statements for any public company that's sitting on any semblance of material amount of this.
Is it a gain if you haven't sold it yet, though? I mean, I guess it's an unrealized gain is what.
So if it's sitting on your balance sheet, let's just make up a number. Let's say you're sitting on $1 million of Bitcoin, and that $1 million was established when the fair value of Bitcoin was $8,000. Then the price goes to, I'm just going to triple it to make it easy, it goes to 24. So now the value of that, what I had on my, as $1 million is now worth $3 million. That $2 million delta, which isn't really the gain because it's like worth 26, it's worth 26, but you have this BS accounting from the past. Do you take that $2 million all as what, operating income? It was marked as operating loss in the past, so you have to catch up through an operating income account?
Maybe you just you undo all of the loss amounts, then I don't know.
Yeah, so are you going back in time and restating it? That's like, people don't do that.
It's not an operating gain though at the same time too, and obviously you suffered from it from the operating loss.
You're recouping from the errors of the past. You're like paying for the sins of the past with like inappropriate accounting guidance for some quarter when this all pops, and then we'll be good out into the future. But and I'm sure all the bankers and the people who trade these equities are like, then they know the most extreme amounts about all these security companies. They know this is coming at some point now. But yeah, that could be an interesting thing in the market in a couple of years here when you have some public companies just presenting.
I guess do two accounting wrongs make a right?
That's exactly.
I mean, this is definitely the right thing to do, but the fact that it's happening now, we have this weird retroactive period. From the article here, it just says, among the more significant changes brought on by this new standard is that cryptocurrency assets will be accounted for at fair value, with changes recognized in net income each reporting period, like you said. These assets will be measured separately from other intangible assets in the balance sheet, so that's good, and changes in the fair value measure of crypto assets similarly will be done separately from changes in the carrying amounts of other intangible assets in the income statement. So it is its own separate thing, even though it does fall under this intangible category. This will give investors a better understanding of the risks and underlying nature associated with the assets, because the new standard also requires companies to provide more disclosures about the crypto assets. So as long as you're looking at the financial statements as a whole, then I think we should be good. What type of mind-blowing information do you have?
I asked Bard how much Bitcoin Tesla has. Now, we don't know how accurate AI is. We've had challenges with some of this in the past. However, it says that Tesla still holds about 184 million of Bitcoin as of the end of Q2 2023. This is down from 1.5 billion that the company invested in Bitcoin in early 2021.
So it's saying
let's do this real quick. All right, what was the price in 2021?
So that's saying that the value, because I'm assuming that what it's pulling is just the current write-down amount.
Exactly. So if they were buying in 2021, the price varied anywhere from like 32,000 up to, that was when it spiked, if you look at maybe up to like 48,000. So you had a big swing in that at that point. Then as you fast forward down, I'm seeing September 30th, 2022. I'm sorry, actually the most damning month, would have been Q4 2022. You would have ended the year at a price of 17,000. So that means that they would have had to cut their original investments probably by half at that point. That would have been the lowest mark that they would have taken. Since then, the price has gone from 16 back up to 27. They haven't been able to realize any of that gain on there. So if they've sold none of it, which they clearly have, if they had a 1.5 billion in 2021 and as of today it's marked down to 184, that means there's some combination of them reducing their position in it and the price going down over time.
Sure.
And so it's hard to interpret what the actual pop is going to be there, but I think you could imagine that if it was marked down.
Well, please hold while I go.
Well, we're rolling. Sorry, I don't know if it's interesting or not to people on the phone. But if you got marked down to 17 grand and then you're going to mark it back up to 25, that means you have a 50% gain ready to go when you do it. So they're gonna recognize about 100 million in gain off Bitcoin.
Sure.
If this thing gets marked 90 million bucks.
What I was saying is,
Sorry everyone for bearing with me through that whole mental gymnastics.
what I was saying is hold on, because I'm about to go ask ChatGPT every company that has significant holdings of crypto so I can go buy their stock.
Well, not ChatGPT because it's not up to date, right? That's why you got to use Bard for this one.
Is Bard the
Google version?
Google version. We love competition. Speaking of competition.
All right, let's move on.
Yes, speaking of competition, the Wall Street Journal recently had an article, a 3% mortgage rate in a 7% world. This startup says it can do it. Can it do it? That's to be determined.
Woof.
This is a company called Rome, and their mantra, your new home made affordable. It's assuming a 2% mortgage could cut your monthly payments in half. Well, we know that. And if you look at the distribution, we've got a little chart here for those who are able to watch, a distribution of all mortgages by interest rates. And most of the mortgages are in the 3 to 4% range. And that's probably a lot of people back in that 2020 through 2021 interest rate cut, and a lot of people buying houses during that point. So you got really good interest rates, but obviously, as you know now, the interest rates are through the roof, and they're talking about loan assumptions, which let a home buyer essentially take over a seller's mortgage. They're hard to find. They're hard to pull off. Rome thinks that they can do it, and they did get backed by they got VC money, so they are making a true stab at this. And I don't know how familiar you are with loan assumptions.
Who invested in them?
That would be an interesting, yeah. Well, you look that up. An assumable transaction doesn't replace an old mortgage with a new one, but instead transfers the old mortgage to a new owner. The seller is relieved of the remaining mortgage liability, so the balance is subtracted from the purchase amount owed. The buyer must come up with the cash to cover the rest of the purchase. So, of course, the interesting thing here is they're convinced that they can get financiers to kind of cover that difference, which why would you do that when you can just give a loan at a higher interest rate? But you obviously need the cash to cover that mortgage payoff from one lender to another. So I'm wondering how exactly they're going to navigate this.
This seems too good to be true and like a really concerning potential collapse in the future.
So I think it's only for the VHA,
FHA.
FHA.
Yeah, FHA, where that's subsidized and you get a better loan anyway.
Right.
Okay. Yeah, and the VC fund that led their round was Founders Fund.
So the article here had said they use this word Luddite, the Luddite world of mortgage banking, which that's a term I had not been familiar with, but the very difficult to navigate world of mortgage banking. The startup could run up against that world of mortgage banking where assumption documents are still often transmitted by fax machine. So perhaps archaic world of mortgage banking. Lenders sometimes drag their feet in processing assumptions because they only earn a few $100s for processing them, often not enough to cover the cost and far less than what they were making by making original new mortgages. So where's the incentive? I mean, that's the game of business, right? Is what's the incentive that somebody else has to buy your product or to work with you or to utilize you? What's their payoff?
Well, this is like too good to be true. Whenever something's too good to be true, you question it. And this is like the idea of offering, I'm on their website right now and it's saying that they can do a 2% rate versus 7.5% rate and suggesting that's going to cut your monthly payment from $3,500 to $8,000. I mean, it's a service like sorely needed, but I just go back to like, man, we've had some shady things happening out there. And this just feels like another one of those like too good to be true. It's like tugging at the heartstrings of people who can't afford a house right now because of where interest rates are and everything. And so, okay.
But I guess they only get a percent of the assumption or whatever it is. They get some sort of percent. That's how they make their money. So how many of these startups do you think in general? I mean, I imagine people with money are doing due diligence to some extent of where they're putting their money in investment. Unless you're talking about like, I'm a billionaire and I've just got $1 million to go throw at something. How many startups just like, because the website looks nice, it looks clean, the concept is really cool. Is it just like one of those money grab situations where it's like, we've got this idea and I'll just be a founder of a startup and I'll take the money and have some fun for a couple of years, and when it all dries up and this thing doesn't work out, then I'll go on and do the next thing.
I mean, the Founders Fund's a legit VC fund. Like that's Peter Thiel's fund.
Okay.
They've done some big stuff and they are known for taking on these like huge, crazy, wild challenges. So this does seem like it fits the bill in that. But yeah, 4 employees. let's check ourselves here a little bit. I'm looking on LinkedIn here, 4 employees, and they've raised a good amount of money from a really great fund. And I think they're just like trying to figure out how to make this work. And we'll see if they can scale this. I think that's the big question. Sure. It's like, it's easy enough for a VC to throw money at a problem that maybe isn't profitable. And that's where you can like, the whole idea of, I can invest in something that's unprofitable today, and if we get to scale, we'll punch through all that and then we'll take over. So maybe there's some long-term play here that we're not fully understanding, and they're going to take on some expense up front. But tough space to be in, and so volatile too. Like what happens if the Fed decides to start cutting rates again? Yeah. Where does the value prop go from there, and how does that all play out? There's a lot of moving parts here. Yeah, man, I love our business.
It's a nice one to be part of as people are struggling to find new ventures. But speaking of struggling to find new ventures, can
we just go the distribution of mortgage rates here is really interesting. This is like a really good indicator of why the housing market is so fascinating. Nobody in that 2%, obviously no one in the below 2%, but like you go up to that probably in 5% number at this point, and nobody's going to sell their house in that range. Right. And we're talking 10, 35, that's like 50% of the housing market, like 55% of the housing market is just not going to be available. And so I have a hard time understanding where a housing market like price correction is going to come from. Yeah. If no one's selling their house.
Well, they all bought them a couple of years ago, and now they're just going to hold.
I don't get it. It's the Airbnb empires.
My parents were talking about how there's a big mistake that they, obviously hindsight's 2020, and now they're nice because they don't have to have a mortgage anymore. But one of the things that was interesting is they didn't, when they sold their house in 2021, they ended up getting a place down in Florida, and they used the payoff from the house in New York to, of course, buy a cheaper house down in Florida, able to cover the whole thing. They didn't need a mortgage anymore. Okay. In hindsight, it's like, should have taken the mortgage.
Free money.
And it would have free money. You'd be making 3% for free on a substantial amount, which would have been nice.
Yep. Hey, shout out if you refied in 2021. You knew what you were doing. Well done.
Good job, everybody. Other interesting thing, talking about, searching for the answer. This is just a funny little thing. This is written by our friend Blake, right? And this was in Accounting Today. The wild classes at CPAs.
This is from Blake. This is great.
Wild classes CPAs take for their 150 hours. And this is something we've revisited a few times about the importance of this. Look at these classes. Just look at some of these classes that we have on the list here.
I know he's putting this out there in jest a little bit, but let me walk you through the curriculum I took at community college after I graduated from school, from real college, to like go and get my 150 credits. I'm not going to remember all of them because I somehow was able to take 18 credits during a summer school session. I found myself negotiating with the dean of the community college on how many credits I'd be allowed to take to do this. But one of them was an intro to astronomy. I took that. I took a physiology course. There was some sort of history 101 course that got slammed in there. And mind you, like I had already taken these classes at Syracuse, like many of them I had already taken. I took an intro to physics class, which I love physics. So that was a piece of cake going through that one. And then my favorite was we took a personal financial planning class, and my brother actually took it with me. And we're like, they're teaching us like what an asset is. And like class one, they're like, here's what an asset is. And we're just sort of like, I don't remember, the teacher was great. He was awesome. Like he was really helpful for like all the other students in the classroom. Like I'm like, oh man, this guy would have been great to have like freshman year or whatever. But there came a time where my brother and I, he also majored in accounting. Like we wouldn't study for this class. We just show up and like take the quiz and tests and stuff and move on with our lives. And the dean, told me I had to do 5 hours of homework per week for every credit of a class that I was taking. And so just mathematically, there's no way I could take this many credits. And I was like, okay, well, we'll see. So we did that. We would always get a 9 out of 10 on the quiz. We get some question wrong. And to the point where like eventually, and my brother and I know that pretty much know the same stuff. So we'd always get the same question wrong. Like about 3/4 of the way into this year, he like accused us of cheating off each other. Yeah. Which I'm like, okay, dude, I'd get how but let me explain. Like actually, like I have my job at EY already. I'm going to EY. I'm here to get my credits for the CPA. So I executed on all of this. So while this might be in jest, this is actually, at least from my perspective, a very real thing to just grab some dumb credits afterwards to fill out your requirements. Like this is the problem with this whole thing. So I love Blake. This is great.
Yeah. One of the things
what was the dumbest class you took?
I didn't take, so I graduated college in 3 years, so I was cramming. Intensively. And so I was kind of crammed in, and then I ended up, when I took my I ended up just staying to get my MBA because I realized that I could double up on classes while I was a grad assistant there and then finish in time. I didn't realize, of course, that I ended up being 3 credits shy of on my accounting requirements because I had majored in accounting, so I didn't take a master's accounting one. And in New York, I needed a 33rd credit instead of just the 30 credits. So I ended up a year later when I was applying for the CPA, they're like, actually, you know, you have your hours and you've passed the exam, but you're actually 3 credits shy on your education. So I ended up taking an online forensic accounting class.
Oh, that's cool.
And it was like fraud and forensic accounting at LSU online. So then I was like, all right. So I had a connection to, I got like the shirt and I'm like, I'm an LSU fan. I went to LSU.
You're an LSU alum. I am.
I'm an alumni. But the craziest thing was actually, when I was getting my master's, I was also 3 credits shy because they didn't realize that I needed, since I didn't have that accounting class, I needed another 3 credits just in general. And by that point, it was already the spring semester. And I was like, well, I'm graduating in May. I'm not coming back here for 1 3-credit class.
Yeah.
I'm studying for the CPA exam at this point. I started a summer class where I was able to extend my apartment for 1 extra week. So I stayed down there, then stayed, because I went to school in Maryland, lived in New York. Stayed at my aunt's in Washington, D.C. That following week, went to senior week, then came back to my aunt's in D.C., went to class, then drove back to New York. And then for the next 3 weeks, I commuted from New York down to Maryland, about 4.5-hour drive for a Monday night class.
Holy.
And I turned around after the 3.5-4-hour class and drove back up to New York.
Wow. Okay. Yeah. Showing the, it's very unnecessary to get these 150. But that's something else.
The thing that I'm just curious about, I just want to, some of these classes are funny. It's like now we got pickleball in here, vegetable gardening. I mean, I would take pickleball. Honestly, gardening seems like it would be kind of useful. Alabama dinosaurs.
Yeah.
That's a funny one.
Intro to the internet.
Canoeing. The other thing.
Also real class. Come on, Blake.
The other thing too that I think is interesting, you talk about the personal finance planning class. I think we take for granted a lot of the times as accountants how easy that stuff comes to us. And I think part of our personality and part of the reason we navigate into accounting is because of just this, it's just our personality type. And I don't know if I got it from my mom, who just was very fiscally responsible, but I help people all the time now. And I'm not a certified financial planner by any means, but I feel like I can do that job just from, well, this is what I do and it seems to work for me. I'm not struggling for anything because I plan properly and I can help you apply these same methodologies. It's just like, don't spend as much as you earn, that way you save.
Totally. Like there's basics. What I found about that class, I found it really interesting how much the other people were learning in that class to like things that I thought were pretty fundamental, like, you know, making more than you spend was definitely one thing. Then you maybe dig a layer deep. The one that really interested me was he asked, you know, hey, how many of you own a car? How many of you have a car that is worth more than you make every year? So a good amount of hands were up. How many of you have a loan against that car? Everyone's hand goes up. He goes, okay, so there is a time and a place for debt. You can use debt and it's fine to pay interest. You never want to be paying interest on what's called a depreciating asset. And so he explains that you're spending more on debt and interest payments to own something that is reducing value over time. And that concept of like those things converging and you're going to be at a point where you've paid a bunch of interest on something that's worth less than you owe on that at this point, and you're going to have to sell it for a loss at some point out in the future, was like mind-boggling for a lot of these people, and helped it click. The people who just like aren't financially minded and don't think, and that is like if you know nothing about money or anything, like that's a unique thing that you have to be taught. And so with that, I was just like, man, like I get that this should be in high school though. This should not be like you go to community college to learn this. Like this is a senior year class around for personal financial planning, how credit cards work, like how much interest can cost you over time. You know, you show how much it piles up over the 5-year life of the auto loan or whatever, and it gets so it was like I thought a really good class. I think everyone should take that just earlier than that.
The concept of even understanding that like just because you have credit doesn't mean like you should go use that. It's just there like in case type of thing. The credit cards are a great concept, but I think so many people are raised or they just naturally fall into the like, oh, I got $20,000 of credit available, so I can go spend that. And it's like, I just use my credit card like cash. It's just a way for me not to carry cash around.
Exactly.
The only thing I do have a question from you as far as like the barrier for accountants though, does it reduce the exclusivity factor and the pride? For me, I don't know. I'm kind of like, if it's harder to get your CPA, it kind of is like, it feels cooler.
there's a bit of that, but I don't think the pride in being a CPA comes from taking the credit hours. I think it comes from like actually working in industry and getting that experience and those hours and actually doing the job, not the schooling. And maybe that's just because once you get out of school and you actually work, you realize that you learn more working, and it's like putting in the hours in audit is really where you learn the most and become like an expert and someone who has a valuable skill set.
So I think perhaps not necessarily just saying, well, we're going to just reduce barriers altogether, but shift where the priority is. So maybe it's a move where you have to get 4,000 hours instead of,
maybe that's a good way to think about it. Because one of the things is you do get very siloed, and it's like you can focus on only audit and become a CPA, but the CPA covers so much more than that. So maybe instead of 150 hours, you say it requires more working hours and has to be more of a diverse background, so you're more well-rounded to become a CPA. Like, maybe that's a way to kind of maintain the prestige without adding on the hours. And what I boil back to is these additional hours require a year of tuition to be paid and lost opportunity for working. And that makes the math so hard to work. So that's a really good way. How do we do it without reducing the prestige? But I also want to remind everyone, like, the 150 thing is recent. We made this harder out of nowhere, like for no good reason. It was 120 as recently as when I was in college. That was like a new thing that was being rolled out. And I have to think that the education industrial complex played some role in having that be a requirement. We'll see if our marketing team edits out my industrial complex line. But yeah, man, like there had to be some persuasion around there around getting kids to go to school for longer. It's easy to pitch that benefit. Maybe I'm becoming jaded with all things go back to profit, but that feels like a good motive in this thing and not something that actually helps people be better.
Sure. So we'd love to hear if anybody has great thoughts. But now on to the Have You Read It section. So obviously last week we had the fun one where we were going through all people's, what they love about accounting. And now I think this is an interesting one because this is just like a sort of hot topic in the area, is the whole return to office and work from home and what's the right balance. What do you think is the reason behind the push back to the office? Any managers in charges want to chime in, and how have staff, performed remotely over the past couple of years? Even before the pandemic, remote jobs were generally worked by the people who had more experience. I think people are starting to come around to realizing that the value of being in the office, especially early in the career, getting trained. You can't just start a job from your home and be expected to learn how to do it like that. I mean, you can watch training videos, you can get on the Zoom or the Skype call, but it's not the same. And it's unfortunate for anybody who had to start working during that period where they didn't have the opportunity.
It really is. I can't imagine being in that situation. And so, okay, I have the CEO perspective here. So this is a very easy topic where if you're a younger employee, you can look up at the executives and be like, they just want us to be in the back in the office. They don't trust us. They want to make sure we're working hard. Or, oh, this is just a way to get people to quit so they don't have to do all that. Like, those are all the cynical stances I've heard on all of this. And if I were a 23-year-old who enjoyed working from home, I would probably feel the exact same way. But I will tell you, from my perspective, as a CEO, people do work better together in person. It is impossible to argue at this point. We've gone through periods now, and I speak from the executive level. Like I have a team there are 7 people who report to me. We did things remotely for a really extended period of time. Within the last year, we've made more of a conscious effort to get together on a more regular basis, whether that's at an offsite or people coming on site for a few days. And every time someone's on site, we have way more productive conversations. You're able to clear up any confusion. Hopping on a Zoom for an hour and being done with it is not a good way to build a relationship or bond with anyone anyway. And so I get that there are a lot of people who enjoy working from home and being by themselves and wanting to do that. That's fine. That's not what's best for business. It's not what's best for business. And reminder, you're an employee at a business.
Yep.
Hate to break it to you.
Yeah.
That's how it goes. That's not what's best for the company. It's not a lack of trust thing over there, but it is if you're in the office, it can helps communication, it helps problem solving, facilitate a lot of that. And it just leads to better culture. And then if you're a younger employee who, wants to onboard and get into the corporate world, like working next to people is a way better way to do that and get up to speed with things. And you have the learning by osmosis thing is very real. To be successful working wholly remote requires, I think, a lot of things that people don't enjoy doing. Like even look at internally at FloQast, there's maybe confusion around something new that we're doing. And it's like always met with, can we have more enablement? Can we have more training? And I'm sitting there like, it's because you're all sitting in your own apartments, not talking about this stuff. There is an ungodly amount of training material available. You know, if someone doesn't know something about the product, we run product office hours every Friday at 10 a.m. Everyone's invited to learn everything about what's going on with product. But since you're at home, it's not, you know, you don't talk to anyone about it. It's not, you're not going to attend the meeting or whatever. And so all of a sudden you're like, I feel disconnected. It's like, we as a company are doing everything in our power to make this available to you. Only thing we can do more is to make you feel connected is to get you in the office, like at this point. So yeah, I have a really hard time with this, and I can understand how there could be a really cynical view around it. But from my perspective as a CEO, I do, in many regards, genuinely think it's what's best for a business to like grow and build and work together. And like I said, like just to hammer on this, we've had communication issues at the C-level, and we're not on the same page with this stuff. And then as soon as you get in the office and you have lunch, or you're in the kitchen, or I plop down in the founder's office, I'll like, you know, sit on their chair and we just talk for 30 minutes. You just get so much stuff cleared out, and it's like way better. It's way better. So yeah, I know we got a little cynical here, and you even see one. If you want a really cynical view, that's it. But it's not the reality of it. So
yeah, I would.
And I also think if you're good at what you do and you do work hard, who cares? Come back in the office. Like if that's your concern is, oh, they just want to see if we're working hard. That's probably a concern coming from someone who doesn't work very hard.
Right.
Like if you're a hard worker, you don't care.
Right. Yeah. I mean, I would press people to be like introspective about this. And like, I am very self-aware that I am way more productive when I'm in the office than when I'm at home. It's just because it changes you from your place of sleep and your place of rest to your place of work. Also, to your point, I love being able to just head on over. If I have to clear up something, I could just go over and ask, and I'm like, I'm just going to get this resolved right now.
Yeah.
And things that have drawn out for like a week of back and forth and pinging, and you're not necessarily understanding the tone or the sentiment, gets completely resolved when you can just go have a face-to-face conversation. It's like, oh, hey, where's that asset, by the way? Oh, it's in that folder. Done. As opposed to like, it's a ping, and then an hour later, it's like the ping back. It's, oh, it's here. So I'm completely on board. And the only people I think where it would be not applicable to is if you're just an individual contributor where you don't really work with anybody else and you just have to go cram in. There's certain situations where I think it's fine to be totally remote, and if you have something to do. That's why I think the balance is it's this hybrid approach of where you make the office the norm, but it's not mandatory, where it's people don't want to sit in traffic on a Friday or a Monday because they got a thing to go to Friday afternoon, and it's just sitting in traffic for no good reason.
Yep. But
But as long as you're able to get in 2 or 3 times a week and have those in-person conversations, it will increase the productivity immensely.
that's probably the best approach, because then you have days at home where you can focus on the individual stuff. And yeah, I think like I look at software engineers, for example, that's a good role where you're not doing a ton of collaborating. You have your small team that you're working with. Maybe you prefer to work that way. You can get it done that way. It can be sufficient. It's still not as good as if you're coming in the office. Like it's still not. It can work, but that doesn't mean it's as good as being in the office. And yeah. All that said, there are benefits to being remote, right? Like from my perspective, I'll go back to we can recruit from a much larger talent pool by not siloing ourselves to a specific city, right? And so I thought there are a bunch of considerations and factors to like that go into this whole thing. Employee happiness and satisfaction is also a consideration. Believe it or not, everyone, CEOs do think and care about you. And that's something that I've definitely thought hard about instead of mandating it. Like, I don't want to mandate it because it doesn't work for everyone, but I do want to encourage more of it because I think it's good. And also just, hey, pro career tip for everyone listening. If you're in the office, executives know who you are. We got a couple people who show up to FloQast headquarters all the time. I know who they are. We have 500, 600 employees at FloQast. I don't know who everyone is, but the ones who show up in the office, I know who they are. It's not gonna be bad for them.
Right, 100%.
Not gonna hurt their career.
I mean, to summarize everything, I think it's just a matter of flexibility. I'm a big palm tree guy. I mean, we're here in LA, so palm tree kind of seems, it could withstand the hurricane, but it always kind of balances itself back out. It's strong but flexible, and I think that's the key. If you want to go,
I like that comparison.
You want to go 2 weeks and work from Scottsdale because you're excited about something, or you have that option to do that. Yeah. But
you want to go on your boat in the summer. Drew wants to push for seasonal flexibility.
Yeah,
exactly.
I mean, like there's times and places. I just want to read some of these comments.
Also, a reminder: you're an extreme extrovert, so you like being around people. You get energy from people. I cannot imagine you in an apartment by yourself.
Drive myself
you
insane.
Go nuts. Yeah, I can't. So
it's not good. So I just want to read some of these comments, which I thought were funny. Training was absolute garbage over the COVID period, and staff quality has suffered. Again, training is a huge aspect of that. Absolutely. As an intern, no offense to anyone, but you can't you can't work from home when you're an intern. You can't be pulling the documents. You don't know what it is you're looking for. You're becoming more of a nuisance than you are. The cynical view is, of course, the you could just arrange to staff turnover, work from home.
Here's one that kills me. You look at that second one. On a more cynical level, firms are tied to long-term leases in expensive commercial areas and need to utilize that asset fully as well. That is simply not true. Like, it's way more efficient for a business to cancel your lease today and pay the cancellation policy. You can pay the cancellation fee and save money in the long run, or you can just let these things fade away into oblivion. And when the lease expires in 7 years, congratulations, you're a more profitable company. So here's one where it's like, I get how you could see that, but it's not true. Yeah. It's just not true.
The bitter, I like this one. The bitter 3 to 6 plus year vets can work from home, but the new blood can't. Yeah, and I mean, that's what I heard
in training and getting ramped up. That feels fine.
A lot of people that own their own accounting firms, they have their own tax practices, whatever it is. I mean, they've been able to now pivot and they can do their whole thing remotely because, again, it's just send me your files. I'm going to do your taxes. I'll submit it, right? Yeah. But if you want to expand and go beyond that, then only downside I see is more traffic, which I liked having nobody on the road for a while.
I like someone here. It's all rounding down. It's all about training and culture. It's damn hard to train a new graduate and accountant person, let alone remotely. It's so like work from home gradually be reduced to a small subset of people that are huge value add, whether they're in the office or remote. I have too many budgets obliterated by an undertrained staff /senior. Like spot on. That's such a good take on it.
So after that, here's some things that are actually in the real realm of being concerning with that's concerning. This one I'll just touch on real briefly. Just obviously through the course of this year, we've just always checked in on inflation, on interest rates and stuff like that. So from the Wall Street Journal, I don't know if this is actually concerning or if this is fake concerning. And this is where I start to get into that audit mentality. The number one article here from this was U.S. inflation accelerated in August due to a jump in energy prices. And the first thing that came to my mind is, well, yeah, it's the summertime. That happens, I'm pretty sure, every year.
Yeah, that's the time of year where they artificially inflate the price of gas. Yeah, that's when it happens.
I don't know.
Well, summer's coming to an end here. I guess like so. Yeah. Another thought here is I'll go cynical. So let's see, includes airfare.
People travel.
One thought is as it does seem like electric cars are making up a larger percentage of the market. How much is that going to start to impact like sales at the pump and price of gas? And so is there going to be some point where Chevron, 76, whatever, all the gas stations are just increasing prices to offset for the loss of revenue from electric cars not going there anymore? So everyone with a gas car has to pay for the profits of.
If I'm these gas stations, I don't want to turn into Blockbuster. I want to turn into Netflix, and I want to also offer electric charging stations at my gas station.
Elon's boxing you up.
Yeah. But anyway, I just think this reminds me of like when it's just like accountants overwhelmed by tax returns this year. I was like, every year. The deadline's coming, as if you are not used to busy season happening every single year. It's like you stress about the same thing year over year over year, the same things that happen. Anyway, that's just one thing to touch on. If you had any more comments.
No, just it's like the core price. I know a lot of this does include like staples like milk, eggs, things like that, and so it seems like. I think it's better that gas is the one buoying the price than things like that people need to survive. So that does seem like a good thing.
But again, I'm so used to the gas price going up in the summer. It's just
that is like things happen. No shit.
So here's something that's actually concerning. This is from Going Concern. This shady Chattanooga accounting firm just went down in flames and still owes staff months of pay. And I was fascinated. I went down the rabbit hole
tell me more.
Finding this article. So this is the firm is Croft and Frost, which is kind of an interesting name too.
Okay.
And I'm just going to do the quick read. The trouble started showing in May when CEO Jonathan Frost, who has DFE'd, I never heard that term before, but that's deactivated all of his social media, sent an email to employees saying the addition of 36 staff, several new product lines, and new leadership team caused a perfect storm of issues. When we make these changes as rapidly as we do, it'll create significant drain on cash flow. That makes sense. The email said, we'll see the fruit of these changes over the next 6 to 12 months. Now, this is all happening back in May. Then all of a sudden, a few weeks later, rumors are flying around that they eventually had to address. They said, I heard they're not going to make payroll. And so eventually the cash flow email came out. There may be a slight delay on the payroll. The only thing that can be guaranteed is that you will absolutely be compensated for all work performed. It just may be a few days late.
Oh boy. Okay.
And as a sign of good faith, if people would just let the paycheck thing go, we'll give you a bonus. So this is when you start to, red flags. Say, this is in an accounting firm. Well, this went on for...
Does that literally say the payroll thing? Or that's you?
No, that's actually in here. There may be a slight delay on the payroll.
But did they use the word thing?
The only thing that can be guaranteed is that you will absolutely be compensated. That's quoted from the email.
Oh, man.
Well, this went on for several months, and employees were still waiting for their paychecks. And this is one of those, like, it's coming. And like, how far can you push this out? And then they just found out last week that they're actually closing the doors to the business.
Wow.
And now apparently they did say, they'll be trued up and they'll get their payments, but they're not going to get that bonus thing. They're not going to get any of the extra. They were supposed to be raise season. They're not getting any of that. They're not getting reimbursed for other expenses. It's just they're going to get their paycheck, and that's it.
Do we know what the firm did?
It seems like they just didn't. According to this, 36, you hired a bunch of people. You didn't actually have the business ready. You overextended yourself, and then you didn't actually.
So you genuinely think it was just poor business management?
It's just really bad business.
You don't think it's like funneling money out?
The reason why,
like that?
Here's the reason why I think it's poor business management. So Paul Thomas Croft, who's the co-founder, so Jonathan Frost, so Croft and Frost. Frost is the CEO. Croft is the chairman of the company. And apparently he's worth $700 million, which also doesn't look too good when you have this smaller sized accounting firm, which you could probably maybe step up and take a little hit.
Yeah, you can that.
He's got 2.1 million. So this is where I think it's genuinely just bad management and people that just don't know what they're doing. He's got 2.1 million followers on Instagram, but I did a little audit, and so I want to bring this up. So I did a little audit, and I put my skills to work here. And I went to I'm like, this guy's got 2 million. I've never heard of this guy in my life. He's got 2 million followers. The real Paulie C 819. Founder of these companies, CVO and executive chairman of Rhino, Emerald Life Insurance. I went to those pages. They've got like 50 followers. He's the founder of these companies. And then I started digging down. I'm looking at his stuff. He's got 2 million followers, yet he's got 7 likes on a picture.
Mm-hmm.
He bought all of his followers and he bought all of his likes. And you could see the time when the company started going down. I have a picture here on the left. He talks about the poof and he plops down. This is one of the videos that he posted. So he's doing all these like very gimmicky Instagram reel type things, super cheap to do, giving financial advice or talking about how to be successful. One of those like wannabe guru type thing, Tony Robbins. 26,000 likes that he's got on this with one comment.
Okay.
That was back in May. So it tells me straight off the bat, you just bought a bunch of likes. Literally a month later, after this stuff starts going down, 7 likes. And all the rest of his posts from that point on since June, have not had any likes on them. And there's no plays, there's nobody watching these things.
So I'm not familiar with this world. So you would buy the followers up front, and then for every post afterwards, you buy likes, or do those followers you acquired like stuff?
So essentially, when you buy followers, unless you're working with a very legitimate agency that's going out and doing organic promotion and getting real people who are active to follow you.
No, I'm talking somewhere. You got
this is
give me a shady building.
This is, and that's more expensive to do that. But this is like for a few $1,000s, he bought a bunch of fake accounts sitting somewhere in like, there's control rooms. I've seen some videos of this before, like in India or China, where there's just control rooms with a bunch of phones that each have like 10 accounts on them. And they just use those accounts to go follow all these things. And they're all completely fake. They follow each other. And then when you buy them, then they'll go follow you. So that's just buying the followers. They're not active. They're not checking up online. So there's nothing to do there. Then when you want likes, then that's a separate purchase, and you just get likes. And if you go through the people who are liking the things, it's like the most random names.
Yeah,
clearly not real people. They don't have any posts.
But you have to do an audit to get there. Yeah. And if you're just taking it at face value, you're gonna believe this guy whose profile picture is him puffing on a cigar here. Yeah, this is definitely the guy I want doing my bookkeeping for me.
We had a background actor from PBC who had bought 2 million followers as well, and this is before you could buy the blue check mark too, and had bought all the publications because you have to be published in 10 different, in order to be verified, you have to be published.
Oh, wow.
Multiple places. And so you could pay for PR places to place you into your websites and onto publications. You could pay for the followers, and then you look completely legit.
And this was a background actor, so we did not factor in their social media presence when hiring them.
No,
right? We were not tricked as part of this. Okay,
yeah. I mean, we're like, oh yeah, let's totally get that. No, I mean, this was just. I mean, it would have been really cool had it been like, oh my gosh, this guy's huge in France. But no.
Fascinating part of casting, by the way, that you consider a social media following when casting an actor.
And this is why
a really interesting thing.
This is why I'm big on personal branding for everybody out there. I'm an accountant. I don't really care. If you are somebody who wants to, it's a resume now at this point. And if you have two people who are equally as qualified, I'm going to go with the actor or the actress who has the bigger following because it's already validated. I already know people like seeing you on camera. I already know that people trust and they like to see you. So it makes it a lot easier of a decision. This person could be a great actor. They killed it at their performance, but like, I don't know if it's going to translate as well. Whereas this person's already made that, they've proven. So personal branding, I think, is huge.
Agreed.
And speaking of personal branding, how should we account for memes? This is something really fascinating too. And this is what I'm talking about, the Wild West. So we have this whole going concern situation with this accounting firm closing the doors and sketchy founders. Where in the world are all of the accounting memes? And this has been like, we've had like a month before we've gotten back here in person in the office. The Big Four accountant has not tweeted or has not posted on Instagram a new meme in 4 weeks. And I'm like, is everybody just on summer vacation? Or I literally did a dive and I was like, there's been no new accounting memes.
Interesting.
Now I want to go do the audit. I want to do the dive. I'm like, what happened? What's going on here?
Well, hopefully just enjoying some vacation. That'd be great. I hope that's the answer.
Yeah, I mean, look, it's people downplay how difficult it is to generate accounting-based content. I mean, you could see something on the street. I was driving on the road today and I saw shoulder work ahead. And the first thing that came to mind, I was like, oh, there's a funny gym meme that you can make out of that. It's a construction sign. Yeah. It says shoulder work ahead. It's like, oh, I didn't know they knew it was shoulder day.
Yeah.
I don't know. It's like I'm working my traps. Yeah. I mean, it comes to you right there. Yeah. Trying to pivot that into accounting. And I know from firsthand being like, how can we turn this into accounting? I'm like, geez, like, I don't know. There's the same 10 jokes that we keep on kind of like pivoting different.
It's surprising how much effort goes into the meme account.
Yeah.
I think just in general, like people don't process that. Yeah. If you're some social media star or something like that, it's actually a full-time job. It is a very real thing.
This one meme I did think, which is an older one, but we had never picked it up before. And this is from Friends, and it's just me, Excel, and 12:12, ... 12.5.
Yeah.
1:12, 1900, 12 p.m. And it's so true. This happens all the time when I'll be putting in information and then it converts it into a date. And
totally. And Google Sheets didn't get this right either. It's as bad, if not worse than Sheets, as I've been using that one more.
So, that makes me wonder, is it time that we start making our own meme accounts? But we're maybe not memes, but we're doing, I think, better stuff.
I like your next meme.
This is a cool opportunity to talk about, and we referenced this a couple months ago when we were talking about it'd be really cool to do man on the street, ask people what is a CPA. Here we are, CPA stand for, and so we finally got around to doing this. So we went down to Venice Beach Boardwalk here in Los Angeles and took the camera crew out. We spent a couple hours walking up and down and asking people if they knew what CPA stood for. And so let's play that video. What does CPA stand for?
It's like the step up from being an accountant. It's like a CPA. It's certified professional.
Do you guys know what a CPA is? What does a CPA stand for?
No, I don't.
Certified public accountant?
Yeah, there you go.
Certified public accountant.
There we go. We're getting some real answers here. Do you know what CPA stands for? Do you know what CPA stands for?
I do, but I can't tell you at the moment.
Yeah, no, it was a very uncomfortable.
What was it like? Because the video I saw, this seems like you in your absolute element. Like this it fit you perfectly, man. So what's it actually like filming one of these?
This was like where you see the movie magic happening behind the scenes.
Okay.
Where it was like a lot of awkward 15-minute stints of like looking around and people being like putting their heads down or like, no, I'm not interested. To extract just the sound bites that you need to make this sort of happen was kind of interesting. And obviously we were there for a couple hours and we ended up with about like a 15 minutes worth of stuff. And then we cut that down, of course, into this one piece of content. Now the full video, which has both what does CPA stand for and what do accountants do, is on YouTube at FloQast Studios YouTube account. And we also have the next one of where we're going to do a little short one of this coming as well, where a lot of people said money management. Of course, you got a lot of tax answers, but we did get a lot of wealth management, managing their money, which I thought was interesting. But it was just awkward because I don't know, you're kind of, you're not offering anything. You're just asking people. I was like a surveyor. So I kind of learned from that experience, and I spoke with my acting coach actually, and he had some kind of good ideas. And what I think would be a sort of interesting thing to do next is, and one of the guys who was actually on the boardwalk who got the answer right was a person who was doing a man on the street video as well. And what he was doing, and I did him and he did mine,
Nice.
is he showed up a picture and he's like, "Can you name this billionaire?" This is the list of the wealthiest people. And what you did is the first person was worth $1. If you said, "Do you want the dollar? Do you want to double it? Do you want to go for the $10 one?" I said, "I'll go for the $10 one." They did the next one. So it was like Bill Gates, then it was Warren Buffett.
I feel like you do pretty well in
Then
this
it was
game.
like Elon Musk. And then I got stumped by, I think it was the guy at Google.
Which, Larry Page?
Yes,
Or
I got stumped by Larry Page.
They've probably created more billionaires than just that also, which is sort of wild.
Yeah, Larry Page, I got stumped by that one. I just didn't recognize the...
It's Sergey Brin, is that the... I think it's Sergey, something like that.
But it was a cool concept because the whole goal was like you went up to $100 if you were able to go through, and you had the decision to make over the course of time. If I had gotten to the $50, I probably would have been like, all right, I'm good with that. I'm not going to risk it after. Take my $50.
Did it end at $50?
So they ended up not having enough bills, so they had to skip around. So I was up for the $50 one and didn't win it.
Didn't win it?
I was like, before that I was at the $10 one. I was going to take $10. I was like, I'll go for the next one.
Yeah, totally.
Like, well, we don't have the $20 one available, so we'll skip to the 50. But I thought it would be a kind of cool concept to something similar where it's name that accounting figure, but it's the actors, because that's a way of sort of blending the two worlds.
Oh, that's a really good, that's a great twist on it.
So you could obviously have the accountant, or anybody listening, as long as they don't run into you and you already know the answers, but I'm thinking like a Ben Affleck. Oh, who's that? Oh, it's Ben Affleck. So it's just name these famous accountants from movies or TV shows. You can have Oscar from The Office.
Yeah.
No, that would be great.
Our friend Oscar. Yep.
So anyway,
closely,
I'm thinking,
or some of the PBC characters as well. That could be the $100 question or whatever. Name, name one.
Yes.
Oh, that's Christian Pierce. Yeah, sweet. Here's your $100. That'd be great.
So so I'm thinking like that's a kind of way to build on it, and so you have a little incentive. You gamify it a little more because there was no reward. It's like, oh, you got it right. I was like, all right, great job, you got it right.
Okay, let's add a reward to it.
But it was still interesting. It was in gamify it, but it was still interesting. Seeing the different responses that people had. So that was a fun little thing to do, and that wraps us up.
And everyone got to see a brainstorm of FloQast Studios content right there, live on the podcast.
And this is what everybody out there with their business. I mean, this is how ideas come to life, and this is talk about the personal branding, talking about I'll be honest, if I look up two businesses and I'm like, who do I want to do business with? I'm going to look at their content. I'm going to look at their social media. I'm going to look at their website. And if it's a rinky-dinky website, I'm like, is this a legit company? And if it's like, oh, well, I'm not in the business of making websites, or I'm not in the business of that, I just provide value to my customer. You judge books by covers.
Marketing matters.
It does.
It's marketing. Marketing matters.
So shout out to marketing because it matters.
Yep.
But I think this was a fascinating segment for the accounting world, to be honest.
Fun discussion. A lot of topics, rail to rail on it. Some fun, some not so fun. But yeah, good stuff.
Well, this is great. So anyway, that's wraps us up. This is episode 15 of the FinTech Flo, and we'll catch you all next time.
Thanks for checking out the FinTech Flo. As a reminder, this episode is available for CPE credit, and you can get that at FloCademy or on the Earmark app. Details are in the description below.